All right, so welcome to another webinar for our investors. And today I have Julian from Traction Financial joining us. Julian, welcome.
I feel very welcome. Thanks, Ash.
Now, you are my personal accountant that I use, and you have helped me over the years sorting out all my bits and pieces, especially when they were, I'm not going to say a mess, but they were definitely needing a couple of years of work on them. So I've always appreciated that, and I've always appreciated your advice as well that you've given me when, there's a lot of your self-managed super funds and personal tax and companies and things like that. So for me, you've been a real all-rounder, which has been super helpful. So I appreciate that. So I guess want to let people know that are listening that you have my personal reference. But can you also just let everyone know that is listening sort of what sort of accounting work that you do and specialize in, just so they know?
Perfect. Well, I'm pleased to hear I have the Ash tick of approval. That means a lot, and it's always a pleasure dealing with you, Ash. I guess by way of background, I've spent a good decade at a large corporate accounting firm, and we primarily dealt with your small and medium-sized businesses, and particularly those that did very, very well. And we would also at the same time handle the wealth that would come from said businesses that we were looking after. And that looks a lot like setting up structures, putting forward tax plans and advice to optimize positions of these fairly wealthy business owners. So that was an awful lot of fun, and I happened to be started off being called the business advisory services space, and I felt like a little bit of a pretender in that I'd never run a business myself. So 7 years ago, we started our practice, and it's going great, great guns, and we've got a really good team, and love it to bits. Wouldn't have it any other way.
It's a husband-wife team, isn't it?
It is, Ash.
You've got to love it.
I know, and a lot of people, or a lot of husbands and wives, couldn't work together. But I happened to meet my wife at the firm that I was at previously, so we know no different whatsoever. So,
well, I have got, what have we got? Six questions that we are going to talk about, which have been questions that you've thought would be really helpful, and questions that I get from time to time in here. So we're going to run through them, but if you are here live and you have any questions that you want us to ask, feel free to either put it into the chat or to the Q&A. I can't remember which one is working and which one's not, but one of them is. So you can pop it in there and I'll ask the question for you. So the first one that I want to ask is, are expenses like buyer's agent fees and property education courses and coaching, are they tax deductible?
Ooh, good question. And I'll start by saying the usual accountant disclaimer, in that whatever I say here, don't believe a word of it until you have gone out and you've spoken to your own personal accountant who knows your personal circumstances. And I have to say that, otherwise I'll get in trouble by the chartered accountants. So starting with that, going back to your question, so we had buyer's agents fees, and we also had sort of professional courses and so on, and the deductibility of both. When it comes to buyer's agents fees, which I'll start with, typically straight out, not deductible per se, but as yourself and your listeners are probably aware, if you buy an investment property, said investment property goes up in value, and you sell that investment property, you've got what's called a capital gain to pay tax on. The buyer's agent's fees are treated in a similar way to stamp duty, as well as settlement costs and so on. Seller's agents or buyer's agents' fees fall into that same mix. They increase what's called the cost base, so the price that you paid for the property. And as a result, when you eventually sell that property, the difference is what you're taxed on. So in short, you don't receive an outright tax deduction that you can claim against your tax in the year that you buy the property. However, it does reduce future capital gains going forward. So that's the first part of the question. And then the second part in relation to courses, seminars, other type of property management type courses or investment courses that you pay for. Again, it depends. If you are taking those courses before purchasing an investment property, then typically they would either be completely non-deductible, or they are treated in a pretty similar way to the buyer's agent's fees in that they bump up that cost base. Alternatively, if you already have the investment property in place and the courses and education are largely around how can I optimize the earnings, how can I essentially maximize the return on my investment that I currently have, and that's currently earning me money and taxable income. They are the ones that you can potentially claim against your rental property income or your income as a whole.
Okay, that's actually really good to know. So I have a little course in Powered Investors, and that is a course that's specifically for investors to be better landlords, but also in regards to different types of renovations they can do, adding value and all of that to the property. It's also got like how to pick a property manager and a few bits and pieces. So that one I think might be worth people knowing about. And if you do have that course, speaking to your accountant and see whether that's something that they would be comfortable in claiming. But yeah, it's a question that gets floated all the time. And as you're talking, I'm just thinking to myself how beneficial knowing some of this would be to property managers as well. So I know while I have this webinar for investors, I'm actually going to share it probably with my property management network because it's good for them to know that. So I appreciate the answers. The next question that comes up a bit is travel interstate to inspect or manage your investment property still tax deductible? And if so, under what conditions?
Ooh, good question, and one in which I'm probably going to break a lot of hearts here. I think it was 2017 that they changed a few different rules, and one in particular relates to whether or not driving out, flying out, taking a long-haul bus, whatever the case is, to go and inspect your property or undertake repairs and so on, is no longer deductible in the vast majority of cases. Prior to that, we used to be able to do all of the good things like estimate the number of kilometres that you would need to travel, claim a cents per kilometre type rate, or even take the actual cost to go and inspect your property. But they certainly didn't like that, I suppose, being a formal ability. Rather, they cancelled that in 2017. There's a few niche circumstances where it may be the case that you can still claim the travel costs. One is if you're running a sort of significant property portfolio and you're almost seen to be in the business of property management or property investment as a whole, then the travel costs can be potentially deducted. They would tend to be where you may be investing via a company. You have several properties on hand in your portfolio, but certainly not typically deductible if it's just a mum and dad type investor.
Yeah.
So again, I apologise on behalf of the ATO, and I would love to see them bring that back in, but only very limited circumstances in which they'll allow it.
Yeah, and I think that I think it's a reasonable thing that they bring back in, but obviously with restrictions like, maybe it's only 2 days, or you know what I mean? Or maybe there's a capped amount as well. I think that because it's something that a lot of investors want to do, and we always encourage them to see their properties, but instead they're relying on us. So I just think it's one of those fair and reasonable things. Do you think that or does it make a difference if they're privately managing the property versus having a property manager? Has that come into sort of any?
Yeah, so well, one of the reasons why they repealed the ability to claim travel deductions in the first place was, uh, in a lot of circumstances, you would get people buying over east from WA, flying over to inspect the property and claiming all of the costs there. And needless to say, that's a little bit of a grey area as to whether you could do it, but people certainly did. So they cut back on that. When it comes to property managers, however, who are professionally managing the portfolio, that travel for the property managers is certainly tax deductible. And again, it comes back to, is the person who's inspecting the property or holds the portfolio, are they running a professional property management business? And if not, then denied. If yes, then big thumbs up, away we go.
Yeah, and it's probably to stop people that have ideas like I just had, which was buying an investment in Bali so I can go visit and check that it's all okay every few months.
Absolutely, and I do love your questions every now and then, Ash. And I think if you could, I would probably be in Bali right now.
Yeah, I know. I do like to be, I use the word creative, but the thing with accountancy I find is that while I do have sometimes creative ideas, it's actually because I feel that with no disrespect to the accountancy role, but you have to be so careful. You know what I mean? There's a lot of responsibility, and I'm sure there's a lot of people that really, really push it. But I also don't know what I don't know. And there are some accountants out there that only give you the bare minimum. So you sort of don't know, like, can I do this? Can I do that? So that's why I ask lots of questions, because I don't know.
Yeah, absolutely, and that's great because it keeps us in jobs. But I completely acknowledge. A lot of the time, us as accountants, we're almost seen as a sort of gatekeeper to the ATO, and there are a bit of flexibility in interpretation when it comes to an awful lot of different circumstances. Sometimes it's clear cut that it's just not possible, i.e., the travel costs. The specific legislation basically denies you claiming those costs. But then there's areas where you've got the sort of, it's clear you can do this particular activity and render it tax deductible. And then you've got the grey. A lot of accountants are fairly conservative in playing in the grey, and rightfully so. In a lot of cases, our number one role is to keep clients out of prison, which is always a good start.
Great goal to have.
It really is. But we tend to find a lot of those in our industry are great at spitting out jargon, and maybe not asking the right questions in an understandable manner that will prompt the potential white areas or the grey areas that I'm referring to here. So it can be very confusing when it comes to properties, which we're obviously talking about today. This area attracts the most ATO attention out of any. Compare it to businesses, compare it to employment expenses and so on. Each and every year for the last however many years, it's very high up on the ATO's target list. They did a survey quite some time ago. Even the accountants get it wrong, the interpretation of rental property rules. And that's just triggered extra scrutiny in that space. So the advice to all listeners would certainly be, if there are any out of the ordinary circumstances, like you are undertaking a significant repair, or you're planning on going to an education course like the ones that you offer, Ash, have a quick chat to your accountant. Just get their tick of approval before proceeding, just because they're going to look at it. If you've got a significant amount sitting in repairs and maintenance on your tax return, even if you prepare it yourself or through an accountant, likely it's going to be scrutinised. They'll ask you for pictures of the repairs. They'll ask you for what you've eaten for breakfast in the morning. They quite often just bring it all together and scrutinize the absolute heck out of it. So this is an area where you've got to be confident in, because ATO is going to have their all-seeing eyes looking over everything.
Yeah, interesting you mentioned photos. I have seen an increase with clients who have started asking for a lot of photos after work's done. And in my mind, I was just thinking, oh, they just want to check on the contractor. But I wonder whether they're going based on their accountant's advice, which is to keep lots of photos for those situations. I didn't actually think of it in that sense. I thought it was just the owner wanting it, but it could be, yeah, them wanting to keep everything squeaky clean on file. Because I think, like, most of my clients, they're pretty squeaky clean. Like, they're definitely not your rogue investors. They're very specific, treating it very business-like as well. So I'll have to keep that in mind as potentially why it's important to continue getting those photos for them, so they're all on record.
Yeah, and specifically, we've seen, I suppose the ATO will come in if they suspect that there's been an overclaim of deductions in a year. They'll actually ask you for before and after photos of any changes that you've made to the property that have caused such an increase in expenses. So we'll probably talk about it shortly, but when you are trying to prove that you've actually undertaken a repair to something that's pre-existing, yes, those things can be very expensive. And what you're trying to demonstrate by taking before and after photos is we are simply changing the current or the state in which that asset was prior to us paying this money to get it repaired. And we want to see a picture afterwards to show hasn't significantly improved the asset as a whole. They'll be looking for a hole in a roof, all of a sudden no longer having a hole in the roof. Those kind of before and after pictures substantiate the assertion that you have paid for repairs, as opposed to buying a brand new asset that you can only claim over a number of years.
Yeah, so we'll get into the difference between the deductions and the depreciations now. So I particularly just want you to talk about hot water system replacements and air cons. They seem to be the most common bigger ticketed items we've got, but also what constitutes the depreciation versus the renovation, because I've just recently had a property where the owner purchased it and it was in a pretty poor state when he purchased it, but there was a tenant in there. Tenants moved out and he spent close to 50,000 on repairs to this property. Now some of them was a repaint, so that's all fine, but like a repair, for example, he had to replace all the ceilings because they had been barriered up in a way, like with a piece of wood, and they needed to be replaced. So that was pretty significant. So like I would suggest, I think that should be a tax deduction, because it was literally a ceiling about to fall down, being boarded up and needed replacing for the next tenant. What's your thoughts on, let's start off with that ceiling and where that could potentially go, and then I'll get you to jump into the hot water systems and the air cons.
Yeah, good question. And it is quite handy when you do have a ceiling that's held upright by something other than what you just mentioned there. Just to clarify, Ash, was the property was purchased, it was then rented out for a period of time?
The existing tenant was in the property when he purchased it, and they continued there for another 12 months.
Okay, amazing. And I guess the damage that was done, was that done whilst the tenant was in there? So it was previously okay condition, and then all of a sudden there was some damage?
Yeah, don't know actually, because it was with the previous owner. So we don't, and the tenant was in there for the previous owner as well. So I don't know that. So would that be a question that would be important to know?
Absolutely. So let's assume that the ceiling started caving in whilst your client held the property. Ceiling starts drooping. You need to pay significant costs to get that ceiling back up to where it needs to be. That would be considered typically a repair, assuming that it's repaired like for like, there's no significant improvements in the ceiling done, then absolutely, the damage is caused during a time in which it was rented out and it was earning the owner income, and as a result, any maintenance costs would certainly be tax deductible. The more grey area would be if the property was previously sort of in that state as it was purchased, and as a result, doing something to alter the building could be seen as an improvement, as bizarre as that sounds, just because you've bought a property at this current state. So ATO don't want to fund your renovations, even though I know it doesn't sound like a renovation. That's where it becomes a little bit grayer, and you would need a little bit more detail on exactly what state it was in beforehand. And again, amazing if, let's say, property management report captures before and after shots that you can potentially use to say, well, this is what it was when the tenant first moved in. This is what it looks like after we repaired it. And that can be used as sort of substantiation for it was not damaged in the first place, certainly was after the tenant moved in. We needed to get it fixed. We're going to claim a tax deduction. There you go, ATO.
Yeah, that all makes sense. So, and that brings me to the importance of making sure that your property manager's doing routine inspections and capturing all of these potential photos that you might need down the track as well. So in WA, we can do up to 4 per year, but in other states, it's not that common. You might only get 1 a year or 2 a year, or maybe there's no inspections. So that, or even if you're self-managing, you're less likely to have photos ongoing of the property. So yeah, for me, that's just triggered the importance of photos. It's not just about doing the inspections to see how the tenant's going. It's sort of record keeping regularly for you to have on file should you ever need it with the ATO. So that it makes sense. It's funny. It's one of those things that like it makes sense, but I never had that thought about it. And that has, yeah, definitely changed my thinking when it comes to the inspections. I'm learning lots of stuff today, Julian. I'm feeling very selfish taking all this knowledge for myself. So thank you.
Go figure.
If we can go into hot water systems and let's go with hot water systems first, because I've heard a few owners tell me different things that their accountants have advised. Now, my thoughts are if you've got a hot water system and it needs to be replaced, that if you're replacing like for like, it should just be a tax deduction. I have had in the past some advice from an owner where they needed a full breakdown because their accountant had told them that they could claim the labour as a deduction, but the actual unit itself, the parts, was depreciation. So what's your take on that?
Yeah, good question. And don't you love it how certain professionals have differences of opinion? And then it usually takes a trip to the pub before everyone's going, well, I got told this. But it's again, it's an interesting one, right? So when you are doing anything to your property by way of what may seem as a repair, you've got 3 real ways to classify the costs of said repair or replacement. You've got one, which is a repair and maintenance claim, which is where you can claim the whole damn thing outright. You've got a depreciable asset that you've bought, and you can claim that over the life of the asset. And every single asset has completely different effective lives that you need to spread your deduction over a number of different years. Those rates, you can actually Google them and jump on the ATO's rental property summary that they release each and every year. And it'll tell you how long a hot water system lasts, how long an air conditioning system lasts, and so on, according to the ATO. And then you've got the third one, which is I'm going to do a kitchen renovation. And kitchen renovations, bathroom renovations, where you're putting tiles down that you can't exactly just rip straight off. You're installing cabinets that you can't just rip straight off. All of these things or most of them, would be considered an improvement to the property or a part of the building per se. They're depreciated, but they're depreciated over 40 years, which often catches people out. So there's certain assets or certain expenses that you pay for where we're talking you get the tax benefit over 40 years. That really hurts. And it emphasizes that whenever you're doing something to your property, be it renovations or otherwise, or repairs, ensure that your invoices that you're getting from some of these professionals who are doing said renovations are splitting out things based on essentially what each cost relates to, right? So installing a new vanity is going to be a 40-year capital works claim if the vanity is installed and you can't easily remove it, versus you get a new air conditioning unit installed, then that needs to be itemized separately on the invoice, and that one we can claim over a far less period of time than 40 years. And as a result, you're maximizing your deductions in that way. Otherwise, if it's all on the one invoice, then the default position for the ATO will say, well, we can't easily jump in there and differentiate between the two. So we're only going to allow a depreciation deduction over 40 years. So that's just a little tip there, I suppose. Jumping back to your original question, which was around the replacing an air conditioning unit and replacing a hot water system. Typically, where you are replacing, you're creating a brand new asset that's going to have a useful life of several years. ATO will tend to take the default position that you need to do the depreciation again, start all over again, and claim it over a number of years, purely because you have a new asset. It's not an outright expense to you because it's going to be worth a number of years. I know that sounds harsh in the vast majority of cases, but the main issue falls with, are you creating a new asset with the work that you're doing, or are you retaining the existing asset? If it's a brand spanking new asset, then typically it will need to be added to a depreciation schedule, claimed over its useful life. If you have an electrician coming in to fix the same air conditioning unit, absolutely claim that outright. There's no new asset, it's the same asset. If you're getting a new one installed, then the technical position is to depreciate it over a number of years.
I'm really not liking that answer.
I'll let myself out, shall I?
Okay, so no, very, very good to know. So parts, for example, in an aircon unit, that's tax deductible because you're not changing the actual depreciable asset in the property. So you've explained it very, very well. It makes absolute total sense. Is there a limit? And I think from memory, I'm not sure why I'm thinking $300. Is there an amount that is, if it's less than $300, that it can just be an outright tax deduction?
Absolutely.
What's the number? Is that 300 or is it that changed?
It's 300. It's 300. What a lot of people won't actually tell you is it's that $300 limit is actually based on each respective owner's share of the property, right?
Okay.
You may not have heard of this one before, but let's say the property is jointly held by 3 different owners. In aggregate, the total cost of the new asset, if it's under $900, you can go ahead and claim that outright. But if it's just a solely owned property, then typically it would be $300 limit before you need to start worrying about spreading those costs over the life of the asset.
And I can't just get my contractor to split the invoice into $300 invoices?
We'll take this one offline, Ash, but yeah.
No need to answer then in that case.
Did I look uncomfortable there, did I, Ash?
Sorry, I threw that one on you. I'm just thinking of, part payments and all that. Yes, you did look uncomfortable, so let's leave that one and keep on moving and people can read what they like into that. The next question that you brought up, and this has actually affected me recently, so I would love to get you to talk about it, and that's your pay as you go. When does it apply to property investors, and what should they be doing to, you know, make sure they're not off, that they're not, you know, caught off guard by receiving pay as you go? Like, what is the pay as you go installment, and who is it affecting?
Yeah, this is one of the most poorly explained system. And if the ATO are listening to this, and hopefully not, they need to rejig the letters that they send out.
I'm popular, but not that popular.
Yes. Well, let's say it's a matter of time, and they may you may have listeners go back in time. But I would say, yeah, effectively, I'm going to try and explain this in the simplest way possible. Employees, they are paid a wage, and they're paid a gross wage of X number of dollars before tax. The amount that they actually receive as part of their weekly, fortnightly, monthly pay run is certainly not the gross amount that's on the employment contract. It's an amount less tax that your employer has gone ahead and paid to the ATO on effectively the same quarter that they've paid, or the same month that they've paid you as an employee. That means that when you go ahead and lodge your personal tax return as an employee, technically you shouldn't end up with tax payable. You may get a little bit of a refund depending on the deductions that you've had in earning your employment income. That's the end of the story. ATO is happy. They're getting the tax as you're earning money. They don't have to wait at all until they get their tax money. That contrasts to those who have a positively geared investment property, or they perhaps run a business, or they receive investment income, in that they are receiving money that hasn't yet been taxed. So I go out, I buy an investment property, I'm privileged enough to perhaps not have a significant loan on said investment property, and therefore my income from the property is greater than my expenses on the property. I have taxable income to declare on my personal tax return if I own it personally. You end up lodging your tax return. If you use an accountant, you lodge it May the following year after the end of the financial year. So almost a year after the financial year's ended. Press lodge on your tax return, end up with a big tax bill, and ATO don't like it. And they don't like it because they've had to wait for almost a year to collect their money. They also don't like it because a lot of people are caught off guard. They don't realize they're going to have tax to pay. And as a result, they put this system in place so that you can shove away enough money and send it off to the ATO in quarterly installments to ensure that you don't end up with a tax bill next year. ATO gets their money, and you're potentially better off by way of you've set the money aside, of which the ATO has specified the amount. It is incredibly misunderstood, and you often aren't aware that that system exists. And if it's the first year of your investment property where it's turned from a negatively geared to a positively geared, or you've just bought a positively geared rental property, you're going to get hit with these quarterly installments. You're going to continue to have to pay.
There's nothing you can do about it.
You are able to vary the installments down. ATO will have a look at what happened when you lodged last year's tax return, and they'll assume the same. You end up with a $5,000 tax bill, then they're going to spread $5,000 in equal quarterly installments over the life of you owning that property until you lodge next year's tax return, and maybe the amount has increased or decreased. Whatever way, they will make an adjustment and say, well, based on, again, the last year's tax return, we're going to increase your installments or decrease them. The only way that you can vary it down or avoid them is if you prepare some estimates and you say, you know what, my interest rate has gone up by 1% over the last year. I haven't increased my rent because I have a fantastic tenant. or I'm a very very kind type of landlord, then you can say, Mr. ATO, my income's going to be less this year than it was last year. I don't think I'm going to end up with a tax bill. And then you go ahead and you vary that installment down to a big fat nil, or whatever the amount ends up working out to be. So you can do something about it. Also worth mentioning, Ash, is how much tax you pay on a positively geared rental property is determined by how much other income that you make in a particular year. The tax system works in such a way in that, you know, the first 18 grand that you earn, you pay absolutely no tax on it. 18 to 45 grand is 16% plus Medicare, and then 45 to 135 these days is 30% plus 2% Medicare. There's these various tiers, and they lump all of your income from investment properties, employment income, and so on when deciding how much tax to apply to each extra dollar of income. So if you lose your job and you're simply relying on the net rental income that's coming through, chances are your total income is probably going to drop. That rental income is going to be taxed at a lower rate. And as a result, let's get out of the installment system.
Yeah.
So,
I mean, you can see how it pays to sort of get advice from an accountant, because if, let's just say that you had all this cash and you wanted to buy an investment property, but you have a wife maybe that doesn't work and is at home with the kids, and then you work, but it's going to be positively geared, this property, you might put it into the wife's name because she's not working, and that's going to be a better tax position as opposed to putting it in both of your names. Like, there's all of those things to check. I mean, I guess if anyone's fortunate enough to be in a position where they get a large amount of money and are making decisions like that, always getting that advice for that setup, I think, it should be compulsory. I just had a question that I wanted to, which wasn't on our list, but it has come up a few times, so I'd love to understand it a bit more. And that is, and I'll keep that as the last question because we're sort of actually run out of time. But I've got some owners where they might sort of ask to hold off on their rent, us paying them the rental income. So because maybe they've maximized something, they've maximized their earnings in that financial year. So they've asked us to put a hold on their payments. Now, it makes no difference to me to put a hold on their payments, but the income that an investor's receiving, is that based on what hits their account, or what they've received on a statement anyway? Does that make sense?
it certainly does. I'm going to disclaim this part because it is one of those somewhat grey areas. I would probably suggest to any of your clients or clients of property managers broadly, I wouldn't be putting that in email because there's something that effectively says the only reason you're doing something is to obtain a tax benefit. And I know that sounds very odd and very strange, but when you
get that, but it's still going to catch up on them at some stage. It's not like it's sort of hidden. They're going to still pay tax on it, but just maybe they're going to leave it for next financial year because that's when they're retiring or something.
Yeah,
I guess it's still tax evasion though, isn't it?
It kind of is.
Yeah.
At the same time, commonly rental income and expenses to a large extent are based on when things are paid or received, right? So in principle, if the tenant just doesn't pay you, then technically that would fall into the year in which it's received. So the email communication aside, with regards to let's hold off, then technically that's correct. You can have it in the next financial year. Likewise with, and I think we were going to touch on some sort of opportunities as well. Same deal with interest expense and insurance costs and council rates and all of those things, typically based on a cash basis, such that if you have an insurance bill coming up and that insurance bill is going to be for a period of 12 months, pay it before 30 June, pay it in the next month and a half. If a lot of people don't realize that you can actually prepay interest if you're on a fixed loan. And I'm not going to branch into a lender's space, but as long as you're prepaying less than 12 months worth of interest on a fixed loan, on a technicality, cash basis, whack that in as an extra deduction in a year. Fantastic for those years where you've earned an exceptional amount of income in your business from your employment income, and you expect that to change in the next year. Why not bring forward those deductions and claim them now when you're on a higher tax bracket and the dollar benefit for each expense is going to be higher?
Yeah, I like that. So yeah, if you are someone that's received a bonus, or maybe you've finished a job and you've had a big leave payout and all of those things, so better, instead of holding off your funds, which you probably technically can't do, you're better off prepaying your council. Sometimes I do get that from clients: council rates, water rates, insurance, and then interest only payments or interest payments. That makes total sense. So then that would probably bring us to I guess, a comment about, there's probably not a lot of people that do this, but I know that we do it as a business, but catching up with our accountant in April or May to do a little bit of planning for the last quarter. So if you were someone, maybe touching base with your accountant in that April, May, and get them just to check and give you that advice, that maybe, yeah, that might be something to consider. And because you've only got a small time frame, you can do it. Once you hit the 30th of June, you've lost that opportunity.
You're absolutely spot on, Ash. And I think for the lead up to tax time, absolutely compulsory if you're a business owner in particular, to catch up with your accountant to help massage these exact matters that we're talking about. Running a business, you can very much massage how much personal taxable income that you have using various structures. There's certain limits on doing that, of course, but when we're talking about distributing profits from a business or from investments and so on, you're looking for a spouse that may be on a lower income that you can potentially send some of those profits off to, again, in line with various requirements. But also those exact same things that you're referring to here, which is you've got to time things, and you've got to time it before 30 June. Once the time's gone, can't do much about it. That also applies to capital gains tax. If you're looking at selling your investment property, you need to know, well, when am I best to sell it and put it on the market? A lot of people don't realize that the date in which you are essentially taxed on capital gains that you make on sale of a property, it's actually the contract date. So when you sign a contract agreeing to sell my property, which settles in 2 months' time, it's actually the date in which you sign off on that, in which you are taxed on. So if you're looking to save on capital gains tax, or at least keep the money for capital gains tax in your bank for an extra year, maybe worth considering selling it in July, putting it on the market in very early July. A lot of timing goes into this. So anything that strikes a chord, go and have a chat to your accountant.
I'm going to give you the heebie-jeebies because I haven't told you that I've actually just sold one of my investment properties. I was your face. I wanted to see it.
Well, hopefully I didn't disappoint there, Ash, but that's perfectly fine. And you being in business allows you with a little bit of extra flexibility to massage that, irrespective of the fact that you have gone ahead and done that. So no, we can work on that, and we've got a few more weeks to go, so no stress.
Excellent, great. No, no stress. I'll give you all those details later on. I need one of those pre-tax meetings with you, which I know that you've sent me an email about, so I'll get onto that You've been incredibly helpful today, so I really do appreciate your time. As property managers, it's not our job to necessarily know this, but what it does help us do is understand enough so that we can point our clients in the right direction. So, for example, with that withholding that money at so they're not getting paid at all before the end of the financial year, where a property manager could help with something like saying to a client, what's your reason for doing it? The client says so, and then just say, listen, it'd be a good idea just to double check with your accountant what you're planning on doing. My understanding is that you may be better to consider prepaying some stuff. So it's just worth having a discussion with your accountant before you make that decision. So we're not giving that advice, but we're just flagging it with them to just double check those things. And that's really, I guess, our job as property managers to really step into that role a little bit more of pointing in the right direction when something is a bit, I think you need to double check that. That's why that's incredibly helpful. So I'll make sure that it's circulated with my property manager as well. And you've explained everything incredibly well, so well that part of me is like, I should have known that, Ash, that, of course, that makes sense. So thank you for being a great, clear communicator as well.
Absolute pleasure, Ash. And please do keep doing what you're doing in that, just having a general understanding of how it works. Even something as simple as a depreciation schedule. Hey, have you considered obtaining a depreciation schedule? The building is not overly old. That can turn a sort of bad tax outcome into a good one. And we still come across new clients who come to us. I'll have a look at the rental statement. I'll Google where the property is online, and it's a build that was built 5 years ago. We've had to go back and amend many years worth of tax returns to claim those sort of deductions that they're missing. Something as simple as that. You guys keep doing it, and the general understanding, that's all you really need to know, and then you can just handball it off to an accountant.
Yeah, perfect. Amazing. Well, thank you so much. I'll give you all my personal tax problems next week, and appreciate your help in advance.
Well, personal tax problems, that scares me a little bit, but I think you're all in the clear there, Ash, so I look forward to it.
No, it's all good. Thanks, Julian.
Cool, pleasure. Thanks so much.